Hello, everybody, and welcome to the Crypto Hipster podcast. This is your host, Jamil Hassan, the Crypto Hipster, where I bring you founders, co-founders, entrepreneurs, executives, thought leaders, artists, you name it, across the world of Bitcoin, blockchain, crypto, all around the world. And today, I have an amazing guest on the other side of the world from me, from all the way from Adelaide, Australia. I'm looking forward to this interview. His name is Joshua Scigala. He is the co-founder of the Standard. Joshua, welcome.
Thank you very much for having me. Yeah, it's pronounced Scigala for those out there. No one gets it right, so I don't blame you.
I've butchered more names than you know.
The butcher of names, nice.
Thank you for correcting me. I appreciate it. So let's kick things off. I look forward to this first question is what is your background, and is it a logical background for what you're doing now?
Right on. Yeah. Well, yeah, I think it's a logical background. I mean, basically I started the world's first swap site back where people could swap clothes. And this was like just after 9/11. So we're going way back. Yeah. And and I because I was researching a lot into what money is, where money comes from, and all that after 9/11, because I didn't trust the official story. I thought there was holes all through it. So it was sort of interesting following gold. Obviously, then you get to central banking, fractional reserve banking. And so we developed this swap site thinking, and also like with, computers and jobs and AI coming in the future, like I knew it was a while away, but um, the talk was always there amongst the cypherpunks and stuff. And so swapping was like, once all the jobs are gone, maybe we can like have this great swapping economy. Yeah, obviously the vision was crazy, but at the time I realized how terrible swapping is. It just doesn't work because you have a whole marketplace of people all with their stuff. Let's say they've got a whole list of things they want to swap. Like I don't know, I've got some headphones and some t-shirts and whatever else. And I say to you, hey, I really love that jumper you have there. Can you look through any of my stuff and see if you like any of it? And then you say, no, don't like it. And I'm like, oh, but I really want that top of yours. Like I've got some good stuff. So how do you make that more fluid? Well, we have a whole marketplace. There's thousands of other people. Obviously, that's where money comes in, right? So we've gone full circle because I could have just paid you, and then you could use that bit of paper to pay somebody else in the marketplace for something you do like, rather than the deal just falling through. And and so I started thinking, okay, well, I'll put a credit system on SwapStyle, and which was the site was called at the time. And the problem was then I was thinking, well, how many credits do I mint? And then I become the central bank. So we're again gone 360. Oh, I could just mint credits out of thin air and start buying people's stuff as a corrupt owner of the system. So I started looking around the web and I came across what the cypherpunks were trying to solve. I didn't fully understand, but I knew that they were looking for a way to do digital cash without a central authority. And I thought it was fascinating, but I came to the conclusion back then that it was not possible because of the double spend problem, where you you cannot, I can't send you an MP3 and say, I've sent it back to you, you know, and you go, oh, thanks. Digital things can be copied, right? How do you know I haven't made a copy of an MP3 and sent it back to you? We can't use digital things as money because you need to absolutely know that I've sent you something and now I don't have it anymore. And so that double spend problem, which came to be known, um, is basically what I thought was the problem that couldn't be solved in a digital space without a centralized authority that was keeping a database. And but yeah, a few years later, because I was already looking and I'd already found what those guys were trying to do. People like Peter Todd, Julian Assange, all those cypherpunk types. Um, I'd I'd very early in 2010 found the white paper that Satoshi had dropped, and and so I thought, when I read that, I thought, my God, they have solved this double spend problem. This is the thing. And really, it was the name that grabbed me, because I loved, how BitTorrent took the centralized model of Napster and made a decentralized version using BitTorrent. And I thought, oh, Bitcoin, it made sense straight away. And I read the white paper. I thought, wow, this is phenomenal. They've done it. And yeah, ever since then, I've been working in the space. I lost then a lot of money in the very first Bitcoin exchange that got hacked, which was called Mt. Gox, MT Gox. And ever since then, I got very, very obsessed with transparency in centralized exchanges and how to solve that problem, because I thought, if you can have the guy that ran Mt. Gox was a guy called Mark Karpellis, and he basically, I don't blame him for what happened, because I think he just was overwhelmed by the amount of data flowing in and out. Like, there's no way to actually determine if you've been hacked very quickly without the right tools. And so I think he just, if he didn't hack himself, which I don't think he did, I think he just wouldn't have known that he was already running in fractional reserve, because he was just dealing with all the, putting out fires and everything, and not seeing the forest through the trees. And so, um, so yeah, anyway, so that's a little bit of my history. So then I started the very first Bitcoin physical gold exchange, because I thought, oh, it's silly. That was in 2014. I launched, I built it. In 2015, we launched. It was the very first order book exchange between Bitcoin and physical gold. So people could trade those two assets, because at the time, every time you took profits off the table in Bitcoin, your bank account got shut down, because the only headline that had anything to do with Bitcoin was about drug dealers and Silk Road and terrorism and everything else, which was all false. Like specifically the terrorism claim was all nonsense. They're all just using, and also the drug war. I mean, the vast majority of transactions to do with drugs is done through US dollars, all the way from paying for the seeds, to planting the seeds, to harvesting the opium, to making the cocaine, to then rolling it up and sniffing up the nose with the bloody US dollar note. Like, and every section of the transaction is US dollars, and it's been shown multiple times that that's the case. Anyway, banks just didn't like Bitcoin, and that's fair enough, because Bitcoin was there to invented to surpass the banks. Um, yeah, and so we built that. We ran it till recently, and then I stepped away 2 years ago and started focusing on stablecoins, because I don't like the fact that we have a vast majority of the stablecoin ecosystem, which is a very, very important part of this ecosystem now, based on centralized companies holding US dollars in bank accounts, because now we have companies that are officially and legally allowed to be in fractional reserve, issuing tokens. So for those that don't know at home, a USDC stablecoin or a USDT is basically an ERC20, which is an Ethereum token, and they make one token for $1 that's sitting in a bank. But the bank can be in fractional reserve legally, so you don't, and it's very, very hard to audit a bank and see actually how liquid they are to creditors and everything else. So yeah, I set out to basically build a truly decentralized and over collateralized stablecoin protocol, so that there's always more assets backing it. Specifically, I got up on stage in 2019 and warned people about Terra Luna 2 years before it crashed, saying this thing is a nightmare. And it's not because I'm some sort of visionary. It is basically because I'd seen it before. I'd seen Dan Larimer try a algorithmic stablecoin. I've seen multiple algorithmic stablecoins fail because fundamentally you can't back a coin with a crap coin that you can print out of nowhere, because effectively you're doing the same thing as fiat. You're just printing money out of nowhere to back a coin that's stable. It might look stable for a while, and then eventually you get more inflation than Venezuela would blush at, you know. But yeah, that's my history on a deep dive. There's a lot more nuance in between all of that with the block size wars and everything else. But yeah, now we're here and we're building basically the standard, which is a 0% borrowing protocol where you issue yourself debt based on collateral that you lock up. You don't give anybody else. So we don't have the Celsius, BlockFi, FTX nonsense. We don't, you basically as a user send crypto to a wallet that you control with your private key. You lock it, and then the smart contract says, okay, now you're allowed to mint new debt against that collateral. And once you do, you can still swap the collateral and trade it and stuff, as long as the collateral value stays the same. And this is what the standard does, is it allows people to lock up real rare assets, like rare numbers like Bitcoin, Ethereum, and then borrow against that at 0% interest and no time limit to pay it back, while still giving them the ability to trade those assets.
That answers my second question, but I want to go back because I don't talk to too many people who were cypherpunks or were knowledgeable cypherpunks between 9/11 and between the advent of Bitcoin, right? But you were in the early 2000s, you know. So how's that landscape of the early cypherpunk days changed into what we have today with all the institutions and everything? What's been the evolution of the cypherpunk and their view of, you know, in Bitcoin?
You know, the initial cypherpunk view hasn't really changed fundamentally. The view is transparency for the weak. Transparency for the powerful, sorry, and privacy for the weak. So this is fundamentally what the goal was, like that the powerful need to be transparent and the weak need to have privacy, so that they, you know, don't get weaker, basically. And the weak meaning, you know, the unbanked or anything else in society. Bitcoin is one of these inventions that allowed for us to play out that dream and say, look, there's a pseudonymous system here. And you can track the wallets of BlackRock now and see exactly how much they're holding. You can track the wallets of the exchanges pretty easily with a lot of the software, this chain analysis software. But you know, every transaction is stored, and if you have good enough software, you can get pretty reasonable data if there is a nefarious transaction in that network. So it's great for law enforcement. You know, I'm a big believer that we shouldn't use money to basically simply find baddies, because what happens is, if you give the power to police or governments to freeze or reach into people's money and say, well, the reason why we have this power is because we need to fight bad guys. Well, that becomes a very, very slippery slope towards tyranny, because then, like we saw with the truckers in Canada, whether you like the truckers or not, it doesn't matter. You can see that there was a group of people who didn't agree with the government's stance on an issue, and the government basically went in and froze their bank accounts, froze their entire family assets, for a political view. Now, this is just a very egregious move, and so Bitcoin allows for true self-sovereignty, and that not to be the case. Now, it is important that police can hunt down predators and sex offenders or whatever, evil people, and stop that. But we shouldn't just say the easy way is uh, freezing everybody's bank accounts until they're proven innocent. Like that's a quick road to very, very awful place. And so we need to get back to good old fashioned police work, and the blockchain allows for that. You can trace and do stuff pretty amazingly. I mean, after I've run a centralized exchange for a long time, and after a while, we were forced by the government to use chainalysis systems, and I was blown away at how absolutely phenomenal the data is that you get back from analysis of the blockchain. But yeah, so in terms of from there till now, I do think the problem that has arisen is when the early Bitcoins were very strong libertarian minded, anarcho-capitalist types, and we, I remember thinking, wow, if this thing takes off, we're going to have a lot of very wealthy anarcho-capitalists that will do great stuff. And then, over time, as the conferences came along, more and more conferences, we went from just having those types to having more and more, lawyers and regulators in there. And then every time there was a panel and then you start getting these sort of celebrity lawyers and big names in, and now we've got Shark Tank people and VCs, and it has changed a lot from the original scene, but fundamentally the idea is still a Trojan horse where we've gone, oh yeah, you like your moons and your Lambos, all these types of ridiculous people who don't actually care about centralization, and hence why you get projects like Solana that can have constant downtime as a blockchain, yet still get pumped up and told that they can run. And I think you tweeted about that recently as well. Like, how can you have a blockchain take itself seriously when it just goes down for maintenance every so often? Like, this is ridiculous, but this is where we are now, that people don't care because they can buy a part of it and it moons. And this is where I see, why regulators get pissed off, like the SEC, because they see it more as a security, which I actually think is silly. People should be able to invest in things without this ridiculous protection. And maybe the SEC should turn into an educational arm instead, where they can educate people of what scams look like instead of forcing them not to be able to invest in them.
I think that's a wonderful idea. I agree with you. So interesting. You know, I have my own opinions about Solana that we probably won't get into because it would take a few hours. But you allow people to to earn yield on as a decentralized exchange by employing something called smart vault, right?
Yeah.
Is your smart vaults work?
Yeah. So like I touched on before, so a smart vault, the fundamental problem was there was a company called Celsius and FTX. What they allowed you to do was you could send them your crypto, your Bitcoin, and you could borrow. They would lend you whatever USDC or something. They would lend you a stable coin. They would charge you a lot of interest for that privilege. And then in the back end, they would go and trade that and try to make money and speculate on it. Hence why they don't exist anymore, because their trades went south during a bear market and they lost everybody's money. And everyone's like, I can't believe it. My money's gone out of, and the other way around, people were depositing money into these products to lend, and they would lend that money to other people. The other people would pay interest, and the company would pay the people that lent the money, that deposited the money, some of that. So what we've done with smart vaults is say, look, we don't need any of this because this is a typical legacy system. This is a legacy financial system brought on chain, rather. So we don't need that. The whole thing is to think outside of the square. So what do? We built a smart contract. And for those that don't know what a smart contract is, maybe I can break it down. A smart contract is nothing more than a computer program. It's nothing more than a computer program. The problem is a single computer program running on my machine here, I don't know whether the output is true because I might have a virus that's manipulating that computer program. If I have a computer program running, any virus can change the output. So if I have 1+1 in my computer program and it comes back 4, then there's probably a virus. But let's say I don't know what the outcome should be, then I have to trust that that's true. So what does a smart contract do differently? Well, it runs a computer program on thousands of computers at the same time. And if 51% of those computers come back with the same answer, I trust that is the truth, that is the truth, because it's very improbable that an attacker and a hacker has hacked every single one of those machines to give the same output. And so a smart contract allows us to now deal with money, because money is one of these things where you do need a computer program that's fully trustless. I don't want to trust that a computer program is outputting correctly. I want to make sure that that's a truth. And you do that by running the same program on many, many machines and saying, okay, anything over 51%, or maybe it could be 80%, whatever you choose. If 80% of the computers have the same output, then I'm going to say, well, that's truth, because the likelihood of every machine being hacked is very low. So we've written a smart contract where users create the contract with their MetaMask or their private key that they control, that generates a new smart vault. This smart vault is running as a smart contract. It's basically a wallet that's a smart contract. And so you get a wallet address, everything, and we don't have access to it. No company has access, no one. It's your smart vault. Now you deposit some Ethereum, you deposit some Link, you deposit some ARB, whatever you're into that smart contract, and then you lock it. Now, let's say you've put $1,000 worth of assets in there, like you've put, $200 of ETH, $200 of Link, and, $600 of ARB, or whatever it is, some sort of portfolio, and you lock it. Our mechanism has to be always 110% over collateralized. That means more value locked up than what you're going to mint and borrow as a debt from yourself. So when you lock it, if you put 1,000 in, let's say you borrow 500, now you're 50% collateralized, because you've still got 50% of that value sitting there. Does that make sense?
Makes sense to me.
Good. So, yeah, the system is that you have to always be 110% collateralized. You can borrow, and the smart contract mints then a fresh, brand new token called EUROS. We're currently pegged to euro. We're going to be releasing USDS, then Indian Rupee S, and a whole bunch of different assets that are pegged to those local fiats. And the great thing is then that is eventually going to be extremely stable once we scale out, because there's always more value back. The people will always want to buy that token back because they have more value locked up than that thing's worth. So, and to get to those assets that they've locked up, they need to get those EUROSs and pay it back. Once they've paid it back, they can get those assets out, and hey presto. So, this was invented actually a long time ago, but MakerDAO really implemented it for the first time years ago. And so the problem with MakerDAO is they only allow a single collateral type in a vault at once. And this is actually across, because a lot of people have forked Maker and created their own versions. And for me, it was like, I don't want to fork it. I need to write this from scratch, because we need to be thinking next generation. How do we scale this? how do we make it better for the borrower? Because what people would do, they'd borrow and then they would be liquidated. Because what happens, by the way, is your smart contract has locked your collateral. You've borrowed against it. Now, imagine China bans Bitcoin or something bad news happened and we start to see the whole market being red and bleeding. Then as soon as the value of that collateral goes down, your collateral ratio starts to go up to until you hit that 110% mark, right? Remember, you need 110% value for what you've borrowed. As soon as it hits that, the smart contract is written in a way to in math to regulate. The regulation is mathematics here, you know. So the regulation says as soon as it hits 110%, we liquidate the entire vault onto a whole bunch of people who have EUROS and are willing to pay back the debt for you. Those EUROS get burnt and those collateral types get sent out for. So they basically buy these assets for 10% under market value because they get 10% more stuff for what they buy because it always has to be 110% over collateralized. And so people are willing to buy these vaults at 10% under market value because, hey, you know, it's 10% under, you get to buy Bitcoin for 10% under what's currently trading for. So, and those EUROSs are then burnt. And this makes sure that there's always more value locked up in the system than there are stable coins floating around. And this is what gives it value. It's type of decentralized gold standard. But fundamentally, a gold standard had government holding all that value in a centralized vault and issuing debt against it and saying you can always get for $1 1 gram of gold. This shouldn't be the way to go. We should say, hey, people can lock up value all around the world. As a sum, there's this much TVL, like total value locked, and this much stable coins floating around. And so that value is fundamentally secure because it's backed by rare numbers like Bitcoin and Ethereum and such. But yeah, you talked about yields. Sorry, I'm going on and on these big diatribes. I'm sorry, audience, if you get sick of listening to my voice.
It's okay because at the end of the diatribe, which is not a diatribe at all, I'll tell you about how I was a Celsius customer and how the loans work there. We can talk about.
Right.
So
Okay, yeah, good. Yeah, I'd be definitely very interested to hear that. So, yeah, so fundamentally how the yield happens, because we're 0% interest, where does the yield come in? Like, how do people earn? Well, because we're the only protocol that allows you to lock up multiple assets and trade. So once you come in for the 0% interest and you say, hey, I've got some ETH, I'm getting whispers that Link is going to do really well. I want to convert some of my ETH that I've got locked into Link. The system uses Uniswap in the background, but adds a 1% fee to that trading. And people are locked in because they've already borrowed against it. So they use the smart contracts. They don't mind paying the 1% because the other option is to pay back your debt, remove the collateral, do the trade, and then maybe take out a debt again. And people would rather pay the 1% than deal with that. Now that 1% fee gets dropped onto people staking the EUROS in our staking pools. And so the more people that lock up value, the more trading, because you can sort of assume that you can say about 5% of all total value gets traded on a daily basis. Sometimes more, depending on the market, sometimes 10%. So if you can scale the TVL, you can assume how much trading will happen, and that those trading fees will get dropped onto stakers. And this is how a yield. And this is really important for the audience to know. If you're going into the decentralized finance space and you see some huge yield, you have to ask, where is that yield coming from? Because if you don't understand where that yield's coming from, do not do it because it's probably a Ponzi scheme or something like that. It's really, really important. If you don't know where the yield's coming from, then you're the yield is the trope.
yeah, I know that. So yeah, a couple times I lost money in Celsius. One was the bankruptcy, obviously, and my money was lost for 600 days and or 600 plus days, and then I finally got some back, like 57%, I think it was, which was as of the lock date. But before that, when there was an operational business, I would take loans, right? And then I had like a bunch of loans, and then the price of the market tanked. And then I got these margin calls. And I'm
Mm.
like, what is that? So you always had to have like a 75% TVL number, like amount, you know, deposited there, or you get the margin call. And, almost lost everything at that one, So,
Mm.
um, but crypto loans should continue to be, something, a product, right? So, what you're doing is different. And but what is the future of crypto loans? It should work the same way as a bank to people, right? It should be a viable alternative to going to a bank. So what do you think the future is there of loans?
Well, I think the future is the standard. I mean, I'm biased obviously because we're building this protocol, but it's a free and open source protocol. That's what the future should be, free and open source. We're building front end now, open source front ends, so anybody can take our code and create a front end for our smart contracts, and allow their customers to start issuing themselves 0% interest debt. The reason why we can do 0% interest debt is because we have no lender. There is no one coming and lending somebody else. Um, and because what's happening in our mechanism is people are locking up their own funds and using that to mint brand new stablecoins. So it's a way of issuing new debt, similar to a central bank, except this is a decentral bank. And it's run by it's regulated by math, regulated by smart contracts. And this is really going back to cypherpunk roots, is that we need mathematics to regulate the system because in a global world, you can't comply with every single jurisdiction. It's hard enough complying with all of these different countries around the world in terms of a centralized exchange. If you have a centralized exchange, it's phenomenal the amount of work. It's something like the European Union allows you to passport. So if you are regulated in in Germany, you get then you're compliant in the rest of the EU. But something like America, you need a license in every single state. So it becomes extremely difficult. So this is why smart contracts are really important, because smart contracts are regulated, have to be regulated by code. They can be pre-read beforehand to say, okay, here's the regulation. If this, then that, otherwise this. And that is the law. And something like FTX and even Celsius, they were highly regulated. FTX was extreme. People go on like say, oh, this is why FTX is why we need regulation. Excuse me? FTX was so highly regulated, yet they still got through because they were run by a bunch of scammers or a bunch of fools that didn't know what they were doing and trusted one scammer, or whatever the reason was. At the end of the day, they managed to get through and they were highly regulated. You know what doesn't get through is when you regulate 2 + 2 to equal 4. It's never going to equal 5, ever. It's always going to equal 4. It's always going to put out the exact number that it should. It is regulated by the laws of mathematics. And of course, you can get hacks. Sometimes we write code where there is a vulnerability. And so you could say that there is a weak point, and it is. And this is where I don't believe in the trope of trustlessness. There is no such thing as being totally trustless. You have to trust the wallet that you're using isn't, going to like run away with your private keys. You have to trust a whole bunch of stuff, especially if you don't code. You have to trust other people reading the code to say in an open source project to say, okay, yeah, we haven't found anything bad in here. So trustlessness there's trust minimal, there's minimal trust, and that's really what we have to aim towards, that we don't need to trust as much. And we can see that many programmers have looked over our code. We recently had an audit of our system of 250 plus white hat hackers trying to break our system for over like a month, and they came back with some vulnerabilities. They came back with some better ways to make the smart contract more efficient, all sorts of stuff. But we've gone through that and patched anything they found, and now we're releasing this. Well, we released it last a couple of weeks ago. So it's yeah, I don't know where I was going with that, but that's basically what we want to get to is trust minimized as much as possible.
I want to talk about that trust because you mentioned a couple things earlier. First, you mentioned chain analysis, and you also mentioned Solana. So there are analytics that are provided by chain analysis, and then there are made up, contrived metrics made up by people who are shilling certain coins like Solana, right? If you're new to crypto, right, and you don't know how to navigate, and you see all these people coming up with narratives and numbers and all this stuff, like how do you begin to know what to pay attention to and decipher between what's trusted and not trusted?
If you're new to Bitcoin and somebody knows that you're new to Bitcoin and they're shilling to you some like trying to sell you on a strange token that uh, that you've never heard of, you do not buy it, no matter what they say. I'm here and I represent the standard because that's what we're working on. We have our own governance token, TST. We have EuroS as a debt. You have to like use these smart vaults. Don't touch any of that stuff. I, you know, if someone is trying to get you to buy something and they know you're a newbie, then you know that there's something nefarious here. Maybe there's not. There's a chance that they're not. If you're new to this, you buy Bitcoin and maybe Ethereum, ETH, BTC, ETH. That's all. You don't touch anything else because there are far too many holes to fall down. Then there are, and look, there are opportunities. Of course, Bitcoin's not going to do another 1000x in the next while. You know, it might double, and that might be enough for you. In fact, that should be enough for you because the legacy banking system will barely give you any of that reward. But fundamentally, Bitcoin has been, when it was invented, people would be like, why is it? It's so volatile and crazy. Well, it's in a price discovery phase. It's trying to find the right value for it. We don't know what this is worth. We've, for the first time, got rare digital assets. We've got digital assets that can't be double spent. So we don't know as a society what this thing's worth. That's why it's like crazy going up and down. And that's why there's such massive, crazy gains, is because it's trying to find its fair value. If someone comes out with another coin and says, yeah, this is the next Bitcoin, I don't know, like it it might be absolutely. I'm not saying it's off the table. There might be a technology that will come and supersede it and get a better network effect, be just as decentralized and wonderful. But um, foundationally, historically, we have one asset right now called Bitcoin, and it is um, it is a it's a good hedge against inflation. Um, it's not perfect. Gold is better. If you're older, if you're heading towards retirement, I would not recommend, well, nothing I say is a recommendation, but I would not buy vast amounts of Bitcoin with your retirement. Um, if you're getting close to retirement, meaning you cannot re-earn any losses, I would stick with gold because you're going to lose, and we're already seeing it. The elderly are losing massive amounts. I don't even know how my wife's mother is struggling to pay rent because rents have gone up so much. She was unfortunate enough not to buy purchase a house through her life, and now she's stuck paying rents that are off on some inflationary nonsense. And so if she was to take her savings, her retirement fund, and put it into gold, it's probably a much better place to be because then at least you will keep up with inflation. And that's the key as you retire. If you're younger, put a percentage into Bitcoin. If you're new to this, once you've been in this game for a year, you've kept an eye, you start to understand all the nomenclature, you start to understand the concepts, then you can maybe put a little bit into some of the other things. But these people that come along, they're new, they get sold on some crazy coin, it's probably going to be a scam. The amount of people I saw scammed and lose everything is horrific. So stick with BTC, Bitcoin, stick with some Ethereum maybe. But yeah, projects like mine, they're more advanced. If you're advanced, definitely come and check us out, and help in the community and stuff like that. But yeah, that's my advice. I don't know. Take it or leave it. Take it for what you paid for it. It's free.
I'm gonna take it. It was a few years ago. I might not have agreed with you, but what's happened over the past few years, I agree with you.
Mm.
So, and so you also want to touch on one more thing. You said you had an announcement a couple weeks ago. I believe that announcement you're talking about was the Ramses partnership, the decentralized
Yep.
exchange partner. How's that? How did that go so far? What do you look forward to, and what's now possible because of that partnership?
Yeah, so um, we looked for a decentralized exchange that had a mechanism to start to build deeper liquidity for EuroS. We've just launched, so we're now incentivizing liquidity pools so that people can earn a yield by adding LP. So going and getting EuroS and getting AG Euro, which is another euro stablecoin, and putting that into liquidity pools. So again, now we're going to get more advanced for those viewers that are more advanced. Um, uh, these decentralized exchanges are wonderful, are absolutely phenomenal. Why? Because they take away the power of the centralized exchanges. We want to get away from, and this is a lot of the time I talk to like Bitcoin maxis who are like, no, Ethereum, it's a scam. No, no, no. But I say, look, you don't like centralized exchanges, and yet we need to trade. Like that's the whole point of the world, is trading and allowing us to move value. We've invented these amazing things because those that don't know, the Ethereum network is about as powerful as a Nokia 8210. Like it's really not a powerful network. So these smart contracts can't handle full order book exchanges. The order books you see on these centralized exchanges, constant trades happening. The amount of computation to make that happen is far too massive for these decentralized. So what these decentralized exchanges have done is they've invented automated market maker, basically pools that that basically always have to be even. It's a little bit different now with V3 pools, but the V2 pools are very, very interesting. You have these two pools, and there's not much computation, and it basically allows for a similar concept of trade and price discovery within these markets. Anyway, on Ramses, you can go and you can deposit EuroS and AG Euro, which is another Euro stablecoin. We've done that because initially we had a pool with EuroS, which is our stablecoin for Euro Standard, and USDC, because we thought, oh, a lot of people will want that pair. The problem was that having a lot of people trade stablecoins or use stablecoins as LP because there's no impermanent loss. So I'm going to get down in the weeds here, guys. But impermanent loss is basically when you've added funds into these pools, and now you've bought the other side of the pair, and now you're stuck with that. Why stablecoins are good is because they're both staying relatively stable, right? And if you have a euro dollar pair, you've now introduced, even though you've got stablecoins, you've introduced forex impermanent loss because the dollar and the euro slightly deviate all the time. And it makes it difficult for people to understand, you know, how much does that have to be today? How much is $1 to €1? Oh, 0.0, no, it's difficult. So pairing with a euro to euro makes it a lot easier. AG Euro has got very good deep liquidity against a lot of the other stable coins like USDC and all of that. So if you did want to trade, the routing systems that are built on these decentralized exchanges, meaning, oh, I want to trade EuroS for, I don't know, um, you know, Shibu Inu or something crazy, the routers will find their way through. Like they'll go, oh, look, there's a pool for EuroS AG Euro, hop. Oh, there's a pool from AG Euro to USDC, hop. Oh, there's a pool from USDC to Shibu Inu, hop. So, and that automatically happens in the back end. And so Our pool with Ramses is euro to euro stablecoin, so it's nice and stable. Of course, there's always going to be slippage because we're what's called a soft peg. It's never hard. We don't promise. We promise like a centralized stablecoin could say, always send us our ERC20. We'll always send you $1. This is a hard peg. A system, a decentralized stablecoin system is more of a soft peg. It's gonna aim to be around €1 or $1, whatever it's pegged to. But yeah, anyway, so you can go check out Ramses Dex, Ramses Dex. We have great, the whole system is built to start building incentives for people putting LP. They start to earn the trading fees that are happening. They start to earn, also, Ramses has their own token that they issue out to people adding LP. And there's, it's all very DeFi, but if you know what you're doing, it's definitely well worth it because we've incentivized those pretty strongly.
Sounds good. And I will add that, when we were watching the Celsius and the FTX and all the companies come bankrupt, there was payments that were going on that were decentralized, and that worked perfectly. Centralized components failed, but the decentralized stuff worked perfectly. So, yeah.
Yeah.
So,
Yeah. This was the problem with Celsius is that they paraded around like a decentralized thing, but they weren't decentralized. They had a centralized thing, system that could get hold of everybody's assets and use it to trade with. And they made some bad calls because they were looking for yield for these people. They were looking for more and more yield. Now, where was the heaviest yield? It was in what was called staked ETH. And staked ETH was basically locked for like years. So once you staked it, yeah, you're getting a yield, but your assets are like locked. So then when everyone was getting margin called and wanted their tokens out, Celsius couldn't get it out because it was staked. Yeah, it was only a good yield, but they couldn't get it out. I think, you correct me if I'm wrong, but I think that was fundamentally the problem there. And then FTX bailed them out. I'm pretty sure, or was that BlockFi? I don't know. But FTX then bailed them out, and then FTX went bankrupt, and
right.
So it was a big cascading. I dare call it comedy of errors, but
It
yeah,
started Terra Luna to begin with because that was an algorithmic stablecoin and not a peg, then
that's
not a.
that's
So
right. Maybe we can touch on that because a lot of people say, "Well, how are you different from Terra Luna?"
yeah. So how are you different from Terra Luna?
I'm glad you asked. Well, let's talk about quickly how Terra Luna worked. So Terra Luna was a coin that had two tokens. One is the stable coin, and one was the governance token. And the governance token didn't have a cap. They could print as many as they want. So how did they make the stable coin stable? What they did is they said, okay, let's say the governance token is worth 50 cents. So what do you need? We take two of those and we place it in this smart contract and we say, oh, look, 50 cents, 50 cents, that's worth $1. So it's backing that stablecoin. So if now what happens if the value of the governance token goes from 50 cents to 10 cents? Then we just print 10 of them and put 10 of them in the smart contract. And now, well, there's 10 of them, so that still equals $1. And so algorithmically, what they did was they took algorithmically and printed more and more of them. Now, in a bull market, you get the illusion that this will work because, hey, everything's going up. A rising tide floats all boats, lifts all boats. And so we had these rises going up and up and up. Terra Luna had to print less and less and less, and it always stuck. Now, then we hit a bear market. And the bear market meant, oh, we need to print more and more, more and more, more and more, and people were invested in Terra in the governance token, which was going down in value. It was going down in value because they had to print more to back their stablecoin, and that was going down in value. So that people started selling. That sell pressure made it even worse, and then it built into a downward spiral where, you know, basically you cannot back a stable form of currency with fluff that you can print out of nowhere. You cannot do it. And this is why I saw it so clearly in 2019, just as they were releasing their white paper. But the problem is that when they offer 20% yield through their anchor partnership, some weird Ponzi mechanic that they had, I can't even explain how that worked. People just went, oh, yeah. And not just the dumb money, meaning not just retail investment. And actually, I find the VC money they call the smart money, it's just as dumb as everything else. And when I say dumb, I mean run by fear, uncertainty, and doubt, run by greed, all of this stuff. We have, what was his name? The guy that got the Terra Luna tattoo like a week before it collapsed.
Nova,
Mark, was it? What was that?
Novogratz.
Novogratz. Yeah, it was Novogratz. I mean, he's a very intelligent guy. I cannot believe that he didn't know, and I have to assume that he didn't know because he got a goddamn tattoo of it. But he couldn't figure out the basics of economic theory. And anyone that studied any sort of economic theory, whether it's Keynesian or it's Austrian, you have to know that value has to come from somewhere. You can't just print value and say it's valuable. It has to come from somewhere. And this was the major issue with Terra Luna. And so how do we differ? Well, we don't back the stablecoin with our governance token. There's nothing to do with the governance. The governance token does something else. But we, first of all, only allow decentralized people, not us, a whole bunch of people to basically lock up more value than they're creating. And that value is locked. They're basically transferring that value into this new thing because that value cannot be unlocked, cannot be released, cannot be withdrawn until they pay back that stablecoin that they've borrowed. And so you're almost saying, okay, I provably have this value here, and now it's in this thing that's a lot more stable, and it's stable because the fluctuations are happening in here. And so it's these are fundamentally rare numbers. There are only 21 million Bitcoin. We can't print more and back the stable coin with it. There are only now Ethereum's a little bit more wacky with its absolutism, but it's actually in a decline now. There's more being burnt every day than there are being created. So that is also a fundamentally rare number. And there's a whole bunch of other assets that we accept. We use Chainlink. We partner with Chainlink. Chainlink is an investor in us through the Chainlink Build program, their accelerator program. They're helping us out a lot, and yeah, I think it's a really nice. Of course, it's all very, very new, so I would recommend that people. Oh, I don't recommend anything, by the way. That's the wrong wording. I would say have a look and check out the way to earn a yield is to issue yourself EUROS and then go for 0% interest and put that into these yield accounts to start buying up any of the fees that are generated. That fundamentally we're very, very different from any of the algorithmic nonsense. So we're a fully asset-backed, decentralized stablecoin and borrowing protocol, and I think it's really fundamental that we have 0%, no usury on the foundation of money, on the base level of money, because that's, the standard is where it's being printed. It's being minted from people's smart vaults, fresh. And I don't have a moral problem with interest, so to speak. Like if I lend you money, I don't mind paying, I don't mind charging interest because there is an opportunity cost for me. I could be using that money to make my house better or to build a business. Instead, I'm lending it to you. So that's where interest is morally absolutely fine. where interest is morally reprehensible is where a central bank can issue money out of thin air and charge interest for it, or when if the standard was to allow you to lock up funds and issue debt and then charge interest for it, and that's what MakerDAO does. I mean, it's ridiculous. It's your own money. You're borrowing money from yourself, yet you're charged interest for that. So it's no good. So that's where I think interest free really is the future, and that's what we're hoping.
Awesome. So that makes a lot of sense to me. It sounds great. So I want to thank you very much for your time today, speaking with me. I appreciate it. And I have one last question. And it's this is how can people find out more information about you, about the standard? How can they try out your platform? How can they do that?
Yeah, just head over to thestandard.io and yeah, just log in with your Web3 wallet and click around, have a go, and check out our Discord as well, or our Telegram if that floats your boat. We've got a whole community in there, and we're always looking, because we're a free and open source project, so we're always looking for people to help out and give us feedback and say, hey, this could be better or that could be better, or um and uh and yeah, if you want to follow me on Twitter, it's the project is at the standard underscore IO. And my personal Twitter is at JSCIGALA. So it should be here, um, at Scigala. And yeah, you can keep up with my ramblings and over there on Twitter.
Awesome. Thank you very much for your time today.
Hey, it's my pleasure. Thanks for having me, Jamin.